Yeah, the Loan Programs Office was originally designed to help commercialize technology. There was a recognition that the Department of Energy was amazing at getting technologies out of the lab and into a commercialization-ready state, but that the private sector was not really ready to take those technologies from there and take them across the bridge to bankability to full market acceptance. And the Loan Programs Office was essential to helping to play that role. And it really did play a very essential role in the commercialization of solar, wind, obviously a famous loan to Tesla, et cetera. But, the Loan Programs Office then went into sort of a dormancy period for 10 years. And today is, back with a lot of loan interest in hydrogen, carbon sequestration and storage, next generation battery chemistries, geothermal, low impact hydro, and lots of other sectors that frankly continue to need our help to cross that bridge to bankability. One of the things that's very interesting about the Loan Programs Office is that we take a lot more perceived risk than we take actual risk. The thing with the Department of Energy's Loan Programs Office is we have access to 10,000 engineers, scientists, and experts on the DOE platform in the national laboratories. And so for many of the technologies that the commercial banks find very risky, we actually know that they have been demonstrated 6 times prior, that there's all these pilot projects. And so the real risk that we're taking is project execution risk, making sure that the management team that is receiving the funds from us knows what they're doing and can operate the plant in a way that meets the financial requirements. And so what I mean by that is that for many of these technologies, you might have only 50% uptime of the plant, and that really the real innovation comes from figuring out how to run it 90% of the time. You saw that in biofuels, you saw that in nuclear power, you saw that in some of these other sectors. And so the Loan Programs Office generally has a very low loss rate. I think it's been roughly about 3.3%, which is in line with where commercial bank loan programs are, while we're taking a lot more perceived innovation risk. The Loan Programs Office really is serving applicants, right? And so there are companies who receive venture capital, private equity, other things. And it's really after 5 years of solid work or longer that they get to the point where they need to deploy a first-of-a-kind commercial plant, manufacturing plant, project facility, or they're doing plants 2 through 6, which we can also fund. Or they're doing the next generation of their technologies, which we can also fund and as they get down the learning curve. And so most of our applicants have already gotten permits, figured out where they want to site their project here in the United States, have received, they've completed a FEED study or some other type of study to determine some of the independent engineering characteristics required to move forward with the project. And so the Loan Programs Office is quite supportive of these projects, and we talk to applicants early, but we often can't help them until they get through their development cycle and they're ready to start construction. For the vast majority of projects, these are generally billion-dollar projects. The average loan request to the Loan Programs Office is roughly $900 million, right? So we certainly do smaller projects as well. We've done projects, loans as small as $44 million. But most of our projects are quite large. And so for these companies, in order to build these projects without us, they generally would have to raise all of that money in equity. So you could imagine them raising, $1.5 billion of equity. So you could imagine them raising $1.5 billion of equity, which you could imagine would be quite expensive for them and their shareholders. And so for most of these projects, you really do need a source of debt to be able to get the projects to final investment decision and into construction. And so the Loan Programs Office plays a really critical role in making something happen that otherwise probably wouldn't happen at all. It's very important to recognize that the existence of the Loan Programs Office starts a clock 5 years earlier, right? So even before we provide a loan, the existence of the Loan Programs Office and people knowing that when they're when they've completed their development cycle, that the Loan Programs Office might be here to really be able to help get a project completed is essential to helping them get started at all. And so when you think about the role that this same program could play in other countries around the world, it can really play that same function. For many of the projects that we build first here in the United States, they may decide that their second project or third project might be in another country. And it still may require a loan guarantee from that other country to be able to support building that project. The other piece of this is that if the U.S. goes first and underwrites a loan out of our office, we certainly can share best practices with that other country around how we thought about the risk reward and how they might be willing to enhance our work from the point that we ended. The Loan Programs Office has been around since 2005 when it was passed in the Energy Act of 2005, and then really issued many of its conditional commitments and loans in the 2009 to 2011 timeframe. More recently, we've put out new loans for the first time in 10 years. And those loans are really in the next generation of technology. So our first phase was really a lot of solar, wind, transmission, geothermal projects, and of course the Tesla loan. In this next generation of projects, we've already done two in the hydrogen space, Monolith Materials and the Delta ACES project, which is the largest electrolyzer paired with a salt cavern that stores hydrogen as seasonal storage. So it's really a modern version of pumped hydro, if you will. We've also looked at projects in the critical mineral space. So we've made announcements to support Redwood Materials, Li-Cycle, Cyber Resources, which is bringing ore from Mozambique and then processing it into a final graphite form here in the United States. We've also provided early support as a conditional commitment to Ioneer, which is using the next generation of lithium processing technology to get lithium out of clay in Nevada. And so when you think about all of the technologies that the Department of Energy has had a hand in facilitating, we're really that last step to helping these technologies cross the bridge to bankability to really reach full commercial acceptance. The Loan Programs Office works best if it really adopts the mindset of a commercial bank. We certainly have a public policy mandate, and so we lean in when a commercial bank would not lean in. But we really try to make sure that we're not lying to ourselves about the risks that we're taking. We're viewing those risks in a clear-eyed way, just like any commercial bank would. And so some of the loans that we have issued have had a high likelihood of default. And we set aside money for a potential default in that case. So in the first iteration of the Loan Programs Office, we set aside $5 billion for potential defaults, of which only $1.03 billion was fully realized. And then we make $522 million a year of interest income for the U.S. government, right? And so I think it's important for people to realize that the goal of the Loan Programs Office is not to subsidize technologies, but to provide liquidity where they can't get that liquidity from a commercial bank, right? And so it's important to find that line, because once you start subsidizing projects with lower interest rates that frankly don't have the rigor around them that is required, then you end up in a slippery slope of having a large amount of losses, and you end up in a place where the Loan Programs Office would lose their mandate. Yeah, I think that when you think about how countries provide credit enhancement, which is, I think, what we're talking about, across all of their institutions. One way to do that is to create, let's say, a monopoly utility company. And that utility company then has a franchise by which it can raise debt in the commercial marketplace, issue bonds, maybe in Western countries, and use those bonds to pay for power generation or transmission lines or other things that they do. When you think about the next generation of technologies like solar home systems or microgrids or other types of more distributed generation, you could imagine that those technologies could be supported through the existing credit enhancement institutions like the electric utility company, or through a new institution that would have a similar mandate from the central government, right? And the goal of it is not, again, to subsidize the technologies, but to recognize that, for instance, in many countries, there's still a heavy usage of kerosene and diesel, where the paybacks for the solutions to those can be quite quick. Let's call it 2 to 3 years. But for most end customers, they don't have cash available to wait 2 to 3 years to get a payback. And so they ultimately end up making a decision that is more costly to their family. And so having this type of credit enhancement would allow for these, quite high rate of return projects to find the liquidity to move forward in a way that a commercial bank may not be empowered to do that because the borrower is not creditworthy, right? But an institution like a utility serves borrowers that aren't creditworthy all the time, right? And so I do think that these issues have been tackled in the past, but they've been tackled in ways that use established business models and not not in a prescribed or intentional way to serve this next generation of technologies.